Welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, very good. Today I wanted to talk about the rising cost of funding and what that means for Australian borrowers, really, because as you know, interest rates haven't moved here, but they have moved overseas, and there's implications for us.
Yeah, so let's start on that, because the chart on screen right now, I think, is the best way to sort of use this as a start point. So you can see the blue line has got the cash rate, which is what we're talking about with the RBA. You can see that they moved in May 2016 and then again in August. The other line, the white line, it's sort of moving parabolic. And I did talk about this last week in Market Watch, but I'll show you for the next chart coming up in a minute. It was moving towards 2%. And it meant that it was basically going to negate those two rate cuts that the RBA did back in 2016. Have a look at the chart on screen now, and you can see very clearly it's gone through 2%. So the 3-month bank bill swap rate, the stuff that you hear about in the Royal Commission, the stuff that you've been hearing about with the fixing issues that the banks had and are still going through that in the courts as well, that's this rate. That's that rate that you can see is through that 2%. I'll come to that in a minute. The other part of that is also, this is the Aussie US dollar swaps, and that's gone through 2.1, 2.16, if you can see on chart there. The reason you show those two charts and the reason it's so important to you and I, or to those of you out there with either a term deposit, but also with a home loan, is that these are the rates that they use short term to basically cover treasury costs. So banks will put their treasury deposits from your term deposit into the 3-month BBSW, and actually for doing that, because they put that with the RBA, for doing that, or with the BBSW, they are charged that rate. So they were used to be charged about 1.6, 1.7. It was normally about 10 to 20 basis points higher than the cash rate. Now it's 50 bips, and they're having to cover that 50 bips of increased costs. It's even worse when you look overseas, because not only that, they've got a US interest rate scenario which is higher than ours, and you can see that. Look at our 10-year, 2.6 odd percent. US is 2.85, 2.89%. That's, you know, a funding gap of 30 bips or 20 bips depending on what it is at the time. Plus you've now got an FX tailwind because the Aussie dollar is headwind because the Aussie dollar is falling on that funding. So putting that all together with the original question, that therefore means two things. Term deposits are likely to see possible declines in their rates because they're trying to make up the gap in their funding charges from the wholesale side, and those with mortgages are likely to see, inside the next 9 months, in my opinion anyway, a probable rate rise. Won't be 25 basis points, but there is every reason you could suggest that it'll be between 5 and 15 basis points as the banks start to feel the squeeze of that funding mix that we just saw.
Yeah. Now, I've had a look at some of the rates online this morning, knowing we were going to be talking about this. So rates, variable rates currently, if you're looking across the board, so not just the big banks, but the smaller lenders and some of the online lenders, they're sitting 3.5%. Some are even a little bit lower, so they're pretty good. They have drifted down over time, from, let's say, 6-8 months ago when they were a bit higher than that.
Yep.
So yeah, I'm hearing what you're saying. We're going to see a little bit of drift up in those principal
and interest loans.
Because
this is the other side, and exactly what I think you've pointed out there is the interesting, probably the more consumer-focused side of this debate and this talk. Is the other side of this is competition, because competition is rife at the moment, and even with increases in funding, the banks are going really, really hard at trying to sort of move through that. And we were also talking off air about new home starts and new home buying. It's just eased off. We know that Sydney and Melbourne has been seeing easing off in the housing market, which means loan demand, as we saw that in the ABS data a couple of weeks back, doing the same thing. So the banks still have to grow their loan book. They've got organic growth there because of the boom they've had since 2013 with the housing-led recovery, but it's starting to slow. And that therefore means that they are out in competition. So rates between 3.5 and 4 on the standard variable rate is incredibly competitive. And you could see a movement from 3.5 to 3.6. If you looked at people that got loans 2 years ago, they're still under. But it could be across the board, and variable rates obviously do change. Doesn't matter whether you started today or you started 4 years ago or 10 years ago. They will move up by a standard rate, and that what that feeds through to back to what we do, which is the economic side, is what it means for consumption in GDP, what it means for the household budget, what it also means for your wage pressure issues that are already there. So let's take the first part of that and have a look at the household budget. We know from coming out from the personal expenditure stuff out of the ABS that they have shown that just shy of 60% of overall weekly take-home pay goes to what they call the basics, and that's household, electricity, gas, etc., education, health, and staple spending, so that's food, etc. It also shows very clearly that the disposable income spending part of your take-home pay is declining quite dramatically. And if that continues to happen with household interest rates moving up, you can just see that divergence going further. So that's one part of it. It also means that there is a pressure on you to keep your job, because if you were to see an increase in your rates, your issue around your employment becomes a bit of a household budget pressure. And we've seen, particularly over the last 3 years, that although jobs are really booming, job security has always been slightly tentative in terms of Westpac's consumer confidence. They've shown you that job security has been a big part of the psyche of the Australian consumer. So all of that starts to feed into the story, and why it's not just an economic story, this actually feeds through to granular level, mum and dad, first home starter, all the way through. So it's a big story to watch, and this is why what's going on over in Washington with the Fed is so important to you and I and everybody else sitting in that market, because our banks, whether it's from the big four through to the regionals, through to some of the credit unions and the building institutions, they are all exposed to wholesale funding, and they're all feeling the same pinch. Yeah,
never lose sight of that. We're really a connected global economy, and whatever's going on in the US, in particular, has enormous ramifications.
Exactly, and you do need to look at it from that perspective. Is that when you talk about it from that way as well, getting back a little bit to more high level, is that when the banks go to the US and borrow, they raise a hybrid or they raise a corporate debt bond to be released in the US market, like CBA and NAB and Westpac have all done themselves in the last 4 years, or Europe or what have you, that debt is denoted in that base currency too. So the debt in the US is denoted in the US dollars. So a falling Aussie dollar, although it's good for our exporters, it's not necessarily good for them, because they also have to fork out more Aussie dollars to cover the US denoted debt and the increased yields they're paying, etc. So it is all connected, and that's what you've got to remember, is that when we do sit on these chairs and talk about the Fed, there is a big reason, is that it does in some way infect you in the medium to longer term.
Thanks, Evan. We'll leave it there today.
Thanks, Tony.
Thanks for joining us on The Economic View.